tech, particularly in the US, has really, really underperformed. It's been a real dog of a sector in recent weeks and months. And just our market has also underperformed in terms of the tech sector. So I've got a chart up there showing the XJO rebased to 100 for the last 12 months. Compared that to the infotech, the XJO infotech sector. So great underperformance there over the last 12 months. So I guess that really does set the scene for Nick. So over to you, Nick.
Thanks, Andrew, and good morning, everyone. That's obviously a pretty terrible chart, but I will start by reminding you, thankfully, we do have an underweight call on tech. So luckily, we have been, at least for a little while, on the right side of that. And so, yeah, we still do hold that underweight call. Obviously, markets are starting to settle down a little bit right now. Obviously, bond yields have come back under that 3% mark, and you're seeing a bit of a rally in the tech names. But just from my perspective, I think you need to see those 10-year bond yields settle at closer to 2.5% for things to really sort of start to normalise. That's my sort of semi-arbitrary line in the sand for when I think people will start having a look again. We have said for a while, underweight tech, particularly steering clear of the small cash-burning companies and favouring the large, liquid, cash-generative, high-quality companies. And that leads me exactly onto Technology One. Technology One did release their result earlier this week. It was a good result, a bit better than I expected, but continues to follow the trend expected. Management are normally very, very conservative, but they were pretty bullish on that call. So I guess before I go into Tech One, the result itself, I really just wanted to remind you why we have a buy on Tech One and why it is our key pick. So as I said earlier, if you want to be in tech, you need to be in the big, liquid, high-quality, cash-generating names, and you can't go any further than Technology One. I honestly think it's one of the best quality companies on the ASX 200. It's a consistent performer. It's compounded about 15% earnings per share growth for decades. It's paid you a dividend all the way along the way, has an ROE of about 40%, and by the end of this year, it's a September year end, so by the end of this year, it'll have a lazy $170 million of net cash on its balance sheet. So it ticks every box you can think of from a financial perspective. I guess arguably the only thing to dislike about Technology One is the fact that it's on a PE of 40 times. But I guess as we all know, you get what you pay for. You've got to pay for quality. This is real quality. So that doesn't deter me. As I said, it is a cash generating business. You're buying it on about a 2.5%, nearly 3% free cash flow yield, and about half of that, so 1.5% dividend yield from Tech One. So you are getting paid to wait while they do all the hard work and compound for you. You can see this slide here, obviously, just to show you the history of dividends, which obviously trails cash generation. So 10% every year for whatever that is, nearly a decade, 9 years. So I thought I'd just spend a little bit of time talking about Technology One. And what they do. They've got 15 products, but really they've got 3 hero products, which are about 50% of their revenue. So those 3 products you can see on your left-hand side. ERP, so think accounting applications for enterprise businesses. That's number 1. Number 2, student management for universities. And number 3, property and ratings for councils. So all 3 of those things are absolutely business critical. No matter what happens in the economy, no business is going to turn off its accounting system unless it goes broke. No university is going to turn off its student management applications unless they go broke. And same again with property and councils who arguably can't go broke because they're all government backed. So really high quality products that are crucial to the business of their customers and really high quality customers. So very, very economically resilient. And as I said, those 3 key products are about 50% of their revenue. The T&E point out that they've only got a maximum 15% penetration. So there is room to keep growing those core products at the same time as getting growth from a number of other avenues that I will talk about in a sec. So this is some of the other avenues. This is a slide they put in their results this week. I just thought it was a great slide. What it shows you is the value add that they add. So basically this is a council back in FY13. A long time ago, they started as a single product customer of Technology One, and they were paying Tech One just under $400,000 a year for their software and just one piece of software or one of the 15 products they have. Fast forward to today, and they're paying Tech One about $3.5 million. They're using 9 products. So it just shows basically what happens. You get in, you provide this really critical software, you do a good job, and then your customer tends to layer a bit more and a bit more on each time. So you get this wonderful compounding effect from existing customers buying more and more stuff, and obviously adding new customers at the same time. That's what's helped them grow through economic cycles, and as I keep harping on about, compound that revenue and earnings growth. So, why are we talking about technology? One, we've really only started talking more about it in the last probably 6 months, or maybe 12 months, I should say. And I guess the key reason for it was this transition. So what this slide is showing you is that basically over the last 5 or 10 years, the company's aggressively transitioned or changed its business model from an upfront to a SaaS or recurring model. I guess from an advisor's perspective, it'd be a bit like moving from purely commission to Wealth Plus. So you take a massive hit at the start, and then you really build this beautiful annuity stream that compounds over time. So at the end, it's a better, higher quality business, but it really sucks at the start because your cash flow falls in a heap. So clearly lots of businesses have tried to do this, and typically there's been a lot of slip-ups along the way. I was kind of hoping you'd get a slip-up from Tech One along the way and you'd get to buy the dip. To their credit, there was no slip-up. They've done an amazing job of transitioning from upfront to recurring. And what they said at this result this week is we're 97% of the way through that now. So I would say they've done and dusted that transition without any major issues at all. And obviously that massively de-risks the business at the same time as making it worth a whole lot more. So I guess that's the slide there. I guess the argument to discuss too is just the valuation side of things. Clearly a recurring revenue, or more importantly, recurring earnings business is worth a lot more than a transitional business. So, that's why this business 10 years ago traded on a PE of 15 times, now trades on a PE of 40 times. I guess we can debate whether 40 is the right number or not. I actually think it's quite reasonable for a business of this quality, but just pointing out that basically with 95%, 97% recurring revenue, 95% recurring earnings, it is a high quality business and it's worth a lot more. And the other thing to point out on this SaaS transition too is that the customer is effectively paying Technology One twice as much. So they were previously paying a bunch of third parties to provide hardware that you run the software on. Their cost, the customer's cost, drops by about 30%. In the process, they pay T&E twice as much. And that is what's going to drive them to get to 500 million annualized recurring revenue by FY26. So basically, they've end of lifed their old product in about 18 months' time. All their customers will switch to SaaS. And without too much stretch, I think you get comfortably to that $500 million target, which they've got. And that's that slide. You can see the 142 mil. That's just flipping existing on-premise customers to SaaS. So obviously, T&E is a much better quality company today than it was 5 years ago. They've transitioned smoothly. Expect the business to continue to compound. So as I said, that SaaS migration gets you good double-digit revenue growth, 10-15% for the next 5 years. They had been dusting money in the UK for about a decade. For the last 2 years, they've actually figured out how to make it work and are making a small profit there. The UK market is 3 times the size of the Australian market. It's a rounding error for them, but it will be a long-term growth driver. And then they also have some sort of third-generation products, which I won't go into right now. But these guys and girls think 5, 10, 15 years ahead. They have a great runway for growth. So that's T&E. I guess just to summarise, wrap it up, the only real negative is the valuation. It's not cheap, but you get what you pay for. This is a really high-quality company. The highlights are 40% ROE, 15% earnings growth over decades, 170 mil of cash, paying you a 1.5% dividend yield to weight. The bull view, you've seen some rallies in tech stocks recently, interest rates normalising and stuff. So if tech rallies in Australia, I would expect Technology One to rally as well. The bear view, if you think interest rates and inflation are going to be a problem for a long time, that's not overly helpful. But when you're compounding 15%, like Tech One, they'll be doubling their earnings every 5 years. So even if you get a bit of multiple compression, the earnings growth will give you a buffer and you get paid a nice dividend along the way. So that's T&E. It's a great company. It's one you want to buy on the dips.